Hello. The National Business Information Clearinghouse and Entrepreneurial Development Center welcomes you to our Beginner's Guide to Financial Statements. This module focuses on the cash flow statement, also known as the Statement of Cash Flow. What is a cash flow statement? It is a record of the amount of cash and cash equivalents that flow in and out of a company for a specific time. Cash includes currency, checks on hand, and deposits in the bank. Cash equivalents are short-term, temporary investments, such as treasury bills, certificates of deposit, CDs, or commercial paper that can be quickly and easily converted to cash. Why is the cash flow statement important? Because cash is the lifeblood of your business, and the cash flow statement helps you understand where money is coming from and where it is being spent. It also alerts you to when a cash flow problem may be coming. The cash flow statement is one of the four main financial statements, which are balance sheet, income statement, cash flow statement, statement of shareholders' equity. A cash flow statement tells you whether the company generated cash. It shows changes over time, usually on a month-by-month basis, rather than showing an absolute dollar amount at a point in time. It uses and reorders the information from a company's balance sheet and income statement. What makes up a cash flow statement? Generally, the cash flow statement is broken down into three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Let's look at each in terms of cash receipts, considered cash in, and cash payments, cash out. Cash flows from operating activities reflect how much cash is generated from a company's products or services. Cash receipts include the sale of goods or services, as well as income from items such as interest and dividends. While interest or dividends could be considered financing activities, the Financial Accounting Standard Board classifies them as operating activities. Operating activities also include your cash payments, such as inventory, payroll, taxes, interest, utilities, and rent. Investing activities reports the purchase and sale of long-term assets, such as property, plant and equipment, as well as investment securities. These investments are typically not part of your everyday operations of selling goods or services. Financing activities reports the issuance and repurchase of the company's own bonds and stock and the payment of dividends. What does a CFS look like? Here is a simplified sample showing the three different sections previously discussed: cash flow from operations, with additions to cash and subtractions from cash, cash flow from investing, and cash flow from financing. How do you calculate the cash flow statement? There are two methods for calculating and reporting the net cash flow from operating activities: direct and indirect method. Under the direct method, you analyze your cash and bank accounts to identify cash flows during the period. This method uses cash accounting, which recognizes transactions only when there is an exchange of cash. The indirect method, which is used more often, uses accrual accounting to determine the net cash flow from operations. Accrual accounting is preferred because it provides a more accurate picture of the company's current condition by recognizing transactions at the time they occur, so both current cash inflows, outflows are combined with future expected cash inflows and outflows. Keep in mind that both the direct and indirect methods produce the same results. Projections can often be inaccurate, so consult with your accountant, attorney, or business advisor when putting together your own cash flow statement so that all the specific information for your particular business is included. It's time to test yourself. Answer true or false. 1. A cash flow statement is also known as the statement of income flow.
False.
2. The cash flow statement shows cash inflow and outflow from operating, investing, and financing activities.
True.
3. While interest or dividends could be considered financing activities, the Financial Accounting Standard Board classifies them as operating activities.
True.
4. There are two methods for calculating and reporting the net cash flow from operating activities: direct and indirect method.
True.
5. The direct and indirect method produce different results.
False.
Congratulations! You now understand the elements of a cash flow statement. For more information about this topic, you can visit one of our customized business information clearinghouses. These websites give you access to a variety of free resources for starting and growing your business. Click on the EDC button to view additional online training topics, including the entire Beginner's Guide to Financial Statements series. Thank you for visiting the Entrepreneurial Development Center, presented by the National Business Information Clearinghouse, the world of business translated. This program was made possible by the generous support of founding sponsor, Western Union.